Hi guys, welcome to Global Macro Flow. So we're continuing our series How to Trade Stocks for Christians. Basically guidelines on helping people new to financial markets with a bit of Christian lingo, which I call Christianese. So today we're talking about the advantage and disadvantage of small and large traders in the stock market. So on what basis are we differentiating small and large traders? It's purely based on capital, that is how much they have to invest. So small traders have relatively small amount of money to invest. They tend to be individual and retail traders, usually trading their own money for investment or income purposes. So 2015 study of retail foreign exchange forex trading accounts showed that the average account size was about $6,600. So given that stock trading is less risky than forex trading, we can generously assume that the average small traders account for stock market is about 2 times that of forex traders account. So that would be say $12,000 or $15,000. So we can assume an average small trader has about $15,000 in capital. Large traders, on the other hand, have relatively large capital to invest. They usually invest in other people's money and then get a percentage of the returns they generate as their profit. So 2018 study where the average large stock account size, large trader stock account size was about $1.8 million. So now for a small trader hearing this information, discouragement is likely to set in. How can I compete with these guys in this market, right? Well, there are two major advantages or disadvantages for the small and large trader. Amazingly, what is an advantage for a small trader is a disadvantage for a large trader, and vice versa. So the first point is ease of entry. Due to the relatively small account size, the small trader has the advantage of ease of entry. You know, the small account restricts the amount of shares that a small trader can buy. The amount of shares that a trader can buy is known as volume. So in most stocks listed on stock exchanges, it is easy to buy or sell the volume of stock that small traders request at any time. So for example, if you want to buy 10 units of Tesla shares, so your volume is 10 shares, it's easy for a small trader to be able to get that amount of shares at once. So if you want to take, so for example, you want to buy Tesla shares at maybe $1,000 per share, and then you want to take your profit at $1,100 per share. Or maybe if the stock goes down to $900 per share, you want to also be able to sell at that point and take your loss. It's easy for you to get 10 units of Tesla shares at that particular amount. Not so easy for a large trader. A large trader will usually end up buying maybe 1,000, 10,000 units of the stock of Tesla or even more. It's not very easy to get that large amount of sellers willing to sell to him at that particular price at once. So maybe he wants to buy 10,000 shares of Tesla, for example. It's very likely that it's not every time that there will be 10,000 shares available for him to buy at the particular price he wants to buy. So therefore, a large trader is usually forced to sometimes purchase stock at higher prices than they will want to do. So the second point, advantage or disadvantage, is staying power. So what's staying power? Staying power is the ability to remain in an investment despite minor bumps that come along the way. The truth is that the stock market never truly goes up in one straight shot. It retraces from time to time. It goes up, reduces a little bit, goes up, reduces a little bit. When it's in an uptrend, it will never go up straight at once. It very rarely does that happen. Look at Tesla stock, for example. Look at how many times it's dropped by 5% of its opening price. Earlier this year as well, the stock fell from over $900 per share to under $400 per share. Now it's back to over $1,300 per share. But if you look at it, if you look at it from the angle of a small trader with little capital might not be able to ride out such retracement. So depending on what his capital is, such relatively normal retracement in the stock market may cause his own account to reduce by 10%, 20%, or even 30% or more. Um, it's not psychologically easy to see that happening and not want to exit, run away, and abandon your trading strategy. But for a large investor, he can even sit down for 3 years on an investment and not feel it because he has adequate capital backing. So is all hope lost for a small retail trader due to low staying power? No. So if you can take advantage of your ability to enter or exit quickly and use quality risk management and think like a private equity investor as mentioned in the last video, a small trader can still build wealth in the stock market. So guys, the call to action, what other advantages or disadvantages to a trader based on capital can you think about? Let us know in the comment section. Bye.